Today, what I thought I'd do is share with you our 2024 outlook. And, the timing's perfect. As you can imagine, we just came out with our outlook recently. And I wanted to kind of share with you what we're thinking about the economy for the year, what we think the Fed's going to do, what's going to happen with interest rates, what it might mean for the markets. And then from there, we'll shift gears a little bit, and I'll take some questions from Craig, and we'll try to answer any questions that folks here have. So I am going to see if I can share my screen real quick, which I believe I can do. One moment, here we go. So we always try to come up with a title that we think sort of embodies the moment in time we're in, right, for our outlook. And this year it's called Testing Resilience. And we think that makes sense because our economy did show tremendous signs of resilience in the past 12 months. I'm the first to admit, a year ago right now, I was a little bit nervous. We all were. We were seeing signs that we were going to have potentially a pretty significant economic slowdown. And you know what? We were all wrong, thank goodness. And we talk about this a lot. We're like, okay, what did we miss? What changed in the economy that allowed us to have a really good year that no one really saw coming? And the truth of the matter is that a lot of things have happened in the past 4 years economically that have never happened before. Right? We've never thrown $5 trillion of stimulus in an economy. We've never had a pandemic where we all sit at home for 2 years and don't spend any money. And it's been a really long time since we had inflation like we've had. So the reality is that as a strategist and an economist, typically the first thing you do to understand today is to kind of look at the history and see if you can find a time historically that you can learn from. I'm not sure there really is anything in the last 50 years that looks anything like what we've been through the last 4 years. So the bad news is it makes it harder to predict where we're going. The good news is that it turns out things were a lot better than we feared. And our economy showed a lot of resilience. All that said, it is going to be tested this year. And as we'll talk about in a moment, there are some things out there to be concerned about. There's also some things to be really excited about with our economy as well. So I thought, to be balanced, we talk a little bit about the good news and the bad news, right? There's some positive things happening. There's some things that are a little bit concerning. Let's start with some of the things that are a little bit concerning and get that out of the way, and then show why we're ultimately very optimistic about this year. So I'm going to jump ahead here. There's a really, in my world, a very famous set of economic indicators that have been around a really long time called the Leading Economic Indicators. LEI for short. It's put out by a group called the Conference Board. This literally goes back to the 1960s. And they're just looking at a bunch of different economic data points that historically have predicted where the economy is going in the following 6 to 12 months. So I would joke it's sort of a blurry crystal ball. It doesn't tell you exactly where things are going, but it has a pretty good track record of telling you whether the economy is due to accelerate or maybe slow down a little bit. Whenever this blue line goes above the black line and it's positive, that means it's saying the economy is going to accelerate. Whenever the blue line goes below the black line, as you could imagine, it means maybe the economy is going to slow down. What you can see here is that the blue line went way below the black line and went very deeply negative. And this is part of why a year ago, a lot of economists were a little concerned. This suggested the economy was due for slow down, and there could still be one coming. That's the bad news. The good news is that it's bottomed. And you can see here that little blue line seems like it's kind of bottomed. It's not getting worse. Maybe it's just starting to head back north. And increasingly what we're thinking is that we might see a little bit of an economic slowdown, but nothing to be that concerned about. Part of it's that we had really, really good growth last year that wasn't sustainable. We had 5% growth in Q3. Last decade, we've averaged 2%. 5 is really high. We think we might be coming back down to kind of more normal levels of growth. So when you look at the growth of the economy in the long run, it typically grows 2 to 3%. We actually think this year might look a lot like that normal long-term trend. Right now, we think the economy might grow about a little over 2% this year. So not a record year, not a great year, but not a terrible year. Could be a year where the beginning is a little bit slower and then things reaccelerate later in the year. But overall, kind of a typical normal year. And for what matters to us, it's likely to be an environment where stocks could do pretty nicely. Are we going to do 25% like we did last year? Maybe not. but we could have a very nice year where we get decent returns and could be more of a return to kind of a normal environment. The second big thing we're watching that is very good news is that inflation is really starting to behave again. And the trickiest thing about whenever we talk about inflation is that there's all these different ways of measuring inflation. On the news, you'll usually hear about the CPI. That's one particular way of measuring inflation. But then people say, you know what? Food and energy are really volatile. So maybe we strip food and energy out, and that's called the core CPI. And I'm not exaggerating. I think there's like at least a dozen different nuanced ways of measuring inflation. The one that's the most important is something called the core PCE. And I'll tell you right now, you're probably not going to hear much about this in the media. It takes longer to gather this data. It comes out a little bit later than other ones. But the reason the core PCE is so important is that this is what the Federal Reserve in Washington is watching. What they've told everybody is that over a long period of time, they want inflation to be about 2%. This core PCE is the measure they're talking about. When times are good, inflation can be a little bit above 2. When times are bad, maybe it goes a little under 2. But 2 should be the trend line. This orange line is the core PCE. This is the number they've been looking at. And what you'll notice here is, see the orange line kind of drop off a cliff? That is really good news. Right now, core PCE has come down from very high levels to about 3.7. Again, eventually the Fed wants it to go to 2, but it's gone from over 5 down to 3.7, and it looks like it's going down pretty quickly. That is very, very good news. That means inflation's finally heading back to a normal level. What does that mean for all of us, besides obviously the obvious in terms of our budget? For the stock market, this is really good because it means that the Fed can maybe start cutting rates sooner rather than later. Once you start to have inflation back in a normal range, the Fed doesn't need to have interest rates as high, and it can start reducing them. Our view right now is that by springtime, we'll have a little bit softer, weaker economy. It'll be fine, but again, a little weaker. Inflation will be back towards the normal range. And our view is that starting in May, we think the Fed's going to start cutting rates. They'll do it slowly, but we think they'll cut rates a little bit at a time throughout the rest of the year. And by the end of the year, we could see interest rates back closer to 3.5%, 4%, rather than the current level, which is north of 5%. That's good for all of us for a lot of reasons. Number one, if all rates come down, that's going to make mortgages cheaper. And I think we all know the housing market is kind of in a tough spot right now. So that'll be good. It'll be good for businesses because they'll be cheaper to borrow. And it's generally really, really good for stocks. When rates are going down for the right reasons, generally that makes stocks worth more. So when you throw it all together, our view is that we could see a pretty nice return in the market this year, but we just got to be a little patient. It might be more middle to later in the year before we start to see that.
Dan, quick question for you.
Yeah.
When I look at this slide, it reminds me of every client meeting when I talk about how inflation has come down and their number one response is, but it doesn't feel any better.
Yeah.
Food is expensive. Energy is expensive. Young people can't find or can't buy a house. Interest rates went up. What's your, and maybe this is an unfair question, but I'll ask it anyway, because this is what we hear constantly. When is it going to feel better?
Yeah.
When are we going to start believing that inflation is actually lower because we feel we've got a little bit more money in our pockets and a little bit more opportunity to get into the American dream where we can go out and purchase a home if we're a first-time home buyer?
Yeah, no, it's a great question. And I always joke that, to be an economist, you need to study economics, but you probably need to study psychology as well, right? Because it's really just the study of humans and human behavior. And you're right, it hasn't felt good. I'd say two things. The first is that we're talking about inflation slowing down, but it's still going up, right? I mean, if the price of everything goes up 2% this year rather than 5%, that's good. It still went up. And it's not going back to where it was 4 years ago, right? This big jump in prices of everything is here to stay. I think where hopefully it'll start to feel better is if we have a year or two where wages go up more than inflation. And that's what's been so tricky. If you look at it, the average US worker is actually making 10% more today than they were 4 years ago. But if the price of everything's up 15%, you didn't get ahead. It doesn't feel good. I think that's the key. If we can get inflation down to 2.5%, and then you start getting a 3-4% raise a year, now you're going to feel like you're finally getting ahead again. So to your point, it is tough, psychologically, to feel this. It probably will take a little bit of time, but our hope is that in the next 18 months or so, we'll start to feel like our raises are finally staying ahead of price increases. That said, Craig, these were like the major kind of messages I wanted to share with everybody. So I know you had some questions for me, so please fire away and don't be too tough on me, but have at it.
We can open it up for everyone to ask questions. It just doesn't have to necessarily be myself. When we think about number one, I mean, going into last year, we were expecting that the Fed we were already be in a recession, and we've already been lowering rates. And let's face it, we were going into November and December with the expectation that there still might even be a rate increase. And I think some folks may say, hey, the Fed they might be done, but no one's ever saying they're definitely done yet. So we're still in that uncertainty type of a period. What's your thoughts in regards to, does the Fed, are we looking at a 1-2 type of rate decreases? Are we looking at mid-year? And then the other variable is, does the Fed even want to, go near lowering rates anywhere near a presidential election, and being perceived as potentially having some influence, in an outcome? What's your thoughts in regards to the frequency, the rate, the velocity of decrease, and whether or not is it a token drop in rates just to be a signal saying lift up your trade tables, bring up your seats, we're starting the descent, we're going to lower 25 basis points and then leave it alone for the remainder of the year until we get through this election? Or do you think they would be a little bit more aggressive than that?
Yeah, it's a great question. And, as much as I would like to tell you that the political cycle doesn't affect the policymakers, they're human beings, right? And, the president, whoever it is the person who decides who the chair of the Federal Reserve should be. So I don't think they're overtly political, but it is something to be considered. So just for context, right now the Fed has rates set at about 5.25, so 5.25. The Fed's been talking a lot in their public speeches recently about what's the neutral level. Like, we know rates are high right now because we want inflation to go down. Long term, though, what's neutral? And they've been saying, maybe 3.5. So we're at 5.25, maybe 3.5-ish is probably neutral. Our view is that they are actually going to cut pretty substantially, from 5.25. Right now, our projection is to 3.75 this year. So we think they'll start in May, and our back of the envelope is that they'll cut a little at a time, 6 straight meetings through the end of the year, and that would bring us to 3.75. And to be clear, this is for all good reasons. It's not because the economy is going to be weak. It's because inflation's come down, and it's time to get in. If inflation's come down, we can get rates back to a normal level as well. In terms of exactly how that plays out, Craig, though, you bring up a good point with the election. Generally, the consensus is that the Fed doesn't want to be cutting rates, a month or two before the election, because they don't even want the appearance of a conflict of interest. Mm-hmm. We think that makes it more likely that they cut a little bit more aggressively earlier in the year. So maybe, between May and September, they do, instead of cutting 1/4 point, they cut 1/2 point, maybe once, right? And try to get it where they want it, knowing that they're probably going to feel like they should pause during Q4. So again, it's all data dependent, but if the inflation data keeps coming in the way it is, we think there's a good chance they are, reasonably aggressively cutting rates by the middle of the year for really good reasons.
And when we think about recession, what we're hearing, I mean, last year, once again, they were thinking by third quarter, we'd be in a recession and we start cutting rates. Now, what we're hearing from a lot of the investment firms out there, that there's been a bigger window, a 6 to 18-month window where a recession. Generally, we're hearing mild and short in duration. And we're also having increased probability of actually a soft landing and no recession.
Yeah.
What's State Street's opinion in relationship to a recession, what we could expect or at least be aware of
Yeah.
as we continue down this path?
Yeah. So, when you hear the term soft landing, it basically means no recession. It does mean a little bit of a slower economy, but it means, again, maybe we go from 5% growth back to 2. That's what we call our base case. We think that's the most likely outcome right now, based on the data we're seeing, is that we don't get a full-blown recession this year. Instead, we just get a slowdown. And you know what? Maybe we have 1% growth one quarter. Maybe it's a little weaker than normal, but it doesn't ultimately become a contraction. That's we think, the most likely outcome. It's interesting, if you look at all the forward-looking economic data, if we have a recession that's going to come, it's probably going to be imminently, like right now. Any kind of economic weakness, we think we're probably going to be experiencing the first half of this year. If we can make it to later in the year and the Fed's cutting, then we're not really worried about a recession at all, because now you're stimulating the economy. Longer term, one of the things that is probably doing the most to keep us out of recession today, that could become a risk next year, is the budget deficit. Now, we are running very, very high deficits right now, considering that we are in a growing economy. And no matter who wins, what happens in Washington, at some point, that's going to have to be dealt with. I will bet you a lot of money, Craig, though, it will not be dealt with in an election year. There's nobody looking for less spending today.
Yeah.
But it could be forced upon us next year. So what's interesting about recessions is every recession we've had, really going back 40, 50 years, there's always a catalyst. Something causes it. It's not like a recession just happens. It's because of COVID, or the crisis in 08, or a number of things, the oil embargo in the 70s. Something has to cause it. And, it could be at some point these deficits we're running create some sort of situation that requires us to really cut back on government spending, and that could temporarily hurt the economy. But that's a 2025 or 2026 problem. It's not a 2024 problem.
So now I want to tap into your Bachelor of Science in Psychology. We've just been going through a global pandemic. And obviously there is a tremendous amount of uncertainty going through a pandemic, because obviously we've never been through a global pandemic before. And there's a lot of Monday morning quarterback, and we should have did this and we should have done that. But when you think about the pain that our clients have experienced in the last 4 years, how does a recession, which is a normal part of the business cycle, feel relative to what they've already just been through?
Yeah, it's a great question, because we technically had a recession during COVID, but it was incredibly quick. And what's interesting is, you look at recessions over time, some of them are quicker than others. Some of them are deeper than others. And some of them are more widespread than others. COVID was a very deep recession. It hit every sector of the economy, but it was really quick. If we were to get a recession in the next year or two, because the Fed's raised rates so high, it might feel very differently. It might actually be a little bit longer. It might take 6 to 9 months rather than short 3-month one. So it might be longer. It actually, frankly, would be almost definitely less deep, right? A much shallower recession. The big question is, in terms of how quickly we recover. A lot of it kind of comes down to how fast the Fed can move. If the Fed is already cutting rates, then I think that it'll probably be a quicker recession, because you'll immediately have stimulus. If the Fed is a little bit slower to stimulate the economy, it could make it last a little bit longer. And I will say our view right now is that if we were to have a recession in the near term, the Fed probably would not cut rates as aggressively as they have in the past. The reason is they don't want inflation coming back. And that's actually something that the Fed has talked a lot about. People forget this, but in the 1970s, we all know we had bad inflation. What's interesting is twice the Fed thought they had beaten inflation. They cut rates, and inflation came roaring back. And they've said repeatedly they don't want that to happen. So that's why we think they are being thoughtful. They're really waiting for inflation to come down before they start cutting rates. If we get a recession, I don't think the Fed would react quite as aggressively as maybe last time around, because they just don't want to create another inflationary situation. So whenever the next recession hits, whether it's next year or 10 years from now, I promise you it'll feel different than COVID, because everyone's just got a little bit different characteristics to it.
You mentioned that you were nervous going into last year. Are you nervous going into this year?
No, and that makes me a little nervous. We're big believers that the market always responds to changes in expectations. Last year, everybody thought things were going to be bad. They weren't, and the market responded really well because expectations really improved, right? Our only concern this year is that expectations are actually pretty high. The consensus is that, you know what, we're not going to have a downturn. The Fed's going to start cutting rates. That's going to be great for the markets. So the bar's just set a little bit higher this year. So the contrarian in me is a little nervous that everybody's a little bit more optimistic. But the truth is the macro data is much stronger than anyone would have guessed a year ago. So there's some really strong fundamental reasons to be optimistic. We just hope the bar hasn't been set too high.
Globally, we have two wars going on right now. What impact or what concern do we have that relative to the markets in 2024?
Yeah, obviously there's horrible things happening, in a number of locations around the world right now. In terms of what it means for us as investors, the reality is that these wars generally only affect our portfolios if they dramatically affect the energy markets. Right, we saw a little bit of that with Ukraine early on when we saw natural gas spike. Horrible things are obviously happening in the Middle East right now, but it's not affecting the oil, and therefore it's not affecting the U.S. and global economy. So it's strictly from an economic and market perspective, that's what you want to watch. Something that would disrupt oil supply. Outside of that, hopefully it would not affect us in any economic sense.
Over the last year, I think we've purchased more money market accounts and CDs than we have in 1 year than we did in the last decade. With a lowering of the interest rate environment projected out, what should clients be aware of in regards to reinvestment risk, things in that nature? Should they continue to stay in that money market? Do we feel it's a better time to start reducing our excess money in cash and buying into the bond market where we're buying at a better premium with competitive yields? Tell me a little bit about your thoughts in regards to a lowering of an interest rate environment and the balance between cash and fixed income products.
Yeah, it's a great question. And look, the honest truth is going to be different for every client, right? And I think that's why it's so important to work with you, because you can sit down and figure out what's this money for. If you need this money in 2 years, you probably still want to keep it very conservative and be thankful that we can get a pretty nice yield in money markets in some of these short-term bonds. It's very different though if it's part of a broader portfolio and you want your bonds to offset your equity risk. And basically, if I'm investing for the long term and I own some bonds, I want my bonds to go up if my stocks go down. And for that type of portfolio, it might make sense to make some adjustments to your bonds right now and maybe take a little bit more interest rate risk because you got a longer time frame, and those types of bonds give you a little bit more protection. So I think it really depends on what that money's for and when you need it. That said, even though we think short rates might come down a bit, we do still think that the Fed's going to keep them in a more normal place. I mean, we went a decade plus getting a yield of 0. That was not normal. And if we go from now, we're getting a yield of, let's say, 5.25. Even if we just go back to 3.5, that's still pretty darn good. And remember, if inflation drops back to 2.5 or so, getting 3.5 on your short-term money is actually great. You're winning. You're coming out ahead. So we'll wait and see how aggressively the Fed cuts. But right now, we think for more conservative money, no problem. Just keeping it simple, keeping it low risk, and being happy with the yields that we can get today.
Yeah, last year we were really pleasantly surprised on how the equity market performed, especially large cap and specifically in the growth sector. We're never in or out of the market, and whether it be the bond market or the stock market. It's just the overweighted or underweighted or what the balance would be. So when you think about the equity markets today, what would be the sectors in the equity markets that you would say, hey, maybe I want to be a little overweighted here, and maybe we want to be a little bit underweighted?
Yeah.
Now, as you mentioned earlier, we're not expecting a correction, but we're also not expecting 25% growth this year. So when you think about weightings, what would be some of the asset classes you would be overweighting, and whether it be fixed income or equity or whatever, and what asset classes do you think maybe, because we might want to start thinking about underweighting? What's State Street's position on that?
Yeah. So, it's a great question. I think whenever you have a year like last year, where one sector like technology does so much better than everything else, it's just usually not sustainable. And one of my favorite quotes is, "If a trend can't last forever, it won't." And technology stocks have really outperformed for a very long time frame now. I don't know when that'll end, but it can't go on forever. So we're not saying you don't want to own the Apples and Googles and Microsofts, but it might be a good place to maybe take some profits and make sure you're not betting too much on them, because they are really expensive. There's other areas of the economy that have been out of favor for a long period of time that are actually really cheap, and eventually we think will be rewarding. Energy stocks are actually our number one sector right now, just in terms of being very cheap relative to their fundamentals. And another one that's been out of favor for a long time is financials. A lot of the big banks right now are actually, knock on wood, appear to be as safe as they've been for a very long time. Don't get me wrong, the stocks can go up and down, but when you think about banks collapsing 15 years ago, it's so much more tightly regulated now that we think that a lot of the big banks are in particularly good shape right now. And we think financial stocks can be a really good place to be. So we're encouraging people to maybe take some of their profits from the growth names like tech, maybe rotate into some of the less glamorous stuff. Final thing I would say is that international investing has been very out of favor as well for a long period of time. And these things all kind of ebb and flow, right? There's cycles. And last time we saw US stocks outperform for 10 years in the 90s, well, you know what? The next 10 years, international did better. And right now, our forecast for the next 5 years is that we think international stocks will do better than the US. Maybe not this year. It's hard to know, how we get from A to B, but we think it is time to start buying international stocks again. Don't go crazy, but maybe having 20-25% of your portfolio in international stocks might make sense, because they're so much cheaper than the US. They could maybe give you some diversification and potentially better returns for the next cycle.
When you think about the international sector, are we looking more in a breakup or a combination of developed as well as emerging markets? Tell me a little bit about what your thoughts are there.
Yeah, and obviously they're two very different things, right? I mean, developed markets would be Europe, the UK, Japan. That's probably where you want more. You probably want more in those developed markets just because they're safer, right? And our view is that you could do pretty nicely and outperform the US over the next 5 years, just because European and Japanese stocks are very, very cheap. Emerging markets are a little bit riskier, and it's more all or nothing. There's actually the potential to get phenomenal returns in emerging markets over the next cycle, but there's just always a lot of risks. China is a great example. Like right now, we've seen a very disappointing year for China economically. We're seeing some problems in their banking system. But you know what? Tomorrow, the Chinese government could come out and announce they're going to give a bunch of money to their banks and prop up their economy, and their stock market might go through the roof. There's no telling. There's a lot of political risk. So I think with emerging markets, I think there's great opportunities, but just know going in that it's going to be kind of a roller coaster, and that there's more of a chance that it goes wrong than other asset classes. But if things go right, you could get some really big returns.
Yeah, just to piggyback on China, obviously China's been really disappointing over the last few years. And I was just wondering whether or not State Street had a position on whether or not the tide is changing, and is it a buying opportunity, or is there just so much geopolitical pressures inside of there that it's such a uncertainty that it's something that you say it's going to be a really small percentage, or maybe I just sit tight and stay away from it until pictures get clear, if ever.
Yeah, it's a good question. In the short term, over the past couple months, we've actually been buying China. It's not because we think everything's great there, but things stopped getting worse. It seemed like their economy sort of bottomed out. And I mentioned before expectations. If everybody thinks something is going to be horrible and instead it's just bad, that's actually good. That's good for their economy. So everybody thought their economy was going to be horrific and said it was just bad. That's actually good for their stocks. And we've taken a short-term position where we've been buying Chinese stocks. I will say, even in just last 24 hours, though, some additional bad information's come out about the banking system in China that might cause us to unwind that position. So here's my thought. I think China is obviously an incredibly important economy. None of us are ever going to totally figure it out, so we shouldn't overthink it. Own a little bit. What's crazy though, Craig, is that we spend a lot of time thinking about China for a lot of reasons. It's only 3% of global stocks. Believe it or not, Canada has a bigger stock market than China. And no one's ever asked me what we think about Canada, because no one cares. So should I think maybe 3% of your stocks should be in China no matter what? Probably, right? And if something goes wrong, it's not going to hurt you that much anyways. But as big as their economy is, their stock market isn't that big. And we probably give them a little bit more, mind space than they deserve.
During the pandemic, obviously, one of the things from an asset allocation perspective, we spent a considerable amount of time, especially on the fixed income side, shortening duration. And obviously we've done that. Does State Street also believe now it's the time to start saying, hey, let's go up in quality? Look at floating rate. Floating rate had a significant double-digit return over the last year. High yield has had a double-digit return over the last high. Is it time to start trimming down those positions and start going back to the more total return, more higher quality, longer duration, traditional types of bonds, considering the fact that they're still below par and paying a competitive yield?
Yeah, it's a great question. It's tricky. Not all bonds are created equal. To your point, there's bonds that are almost basically guaranteed to get paid back from the government, and then there's junk bonds that have really high yields but have a lot of risk. The way we tend to think about it with a portfolio is that it doesn't matter whether it's a stock or bond. Is it a risky investment or a low risk investment? When you mentioned high yield bonds and bank loans, those are higher risk. We actually like those a lot if you put them as part of your stocks. They actually act a little bit more like stocks than bonds. And in that context, we think they might be worth buying. On the other side of the ledger, though, a lot of us have maybe 40% of our investments in bonds. I want those to be high quality. I want those to be lower risk. And as I mentioned earlier, I want those bonds to go up if my stocks go down. So the short answer is yes. We think for your core bond position, it's time to increase the credit quality, add some interest rate risk or duration, and kind of go back to a more old school approach, which is keep it simple with your bonds and take your risk with your stocks.
Well, Dan, is any last bits of wisdom and information that you'd like to share with our group before we wrap up? I just want to kind of leave you with the last word.
Well, no, I want to thank you. I appreciate it. And, thank you. And thanks to everybody who joined us here. And And Craig, you got a great group here. And for all of you, I think it's wonderful that you're working with an advisor like Craig and his team. I think these are times where you really need a plan. And everything we talked about here today doesn't really matter if you don't have a plan for your investments. If you don't know what you're investing for, where you're trying to get. And I think sitting down and really being thoughtful about what I'm trying to accomplish is honestly 90% of the battle. So thank you everybody for having me here today. And Craig, thank you and the team. It's been a pleasure and would love to do it again sometime.